So you're out of the city. Is it snowing or raining over there?
Yeah, it's definitely. Hi everyone. Well, I can see people flowing in. Um, it it's snowing, but not too bad. Uh,
Yeah, we're getting the snow here, just not sticking. That's good.
it's right at that temperature where it's, could be slippery and dangerous if you're driving. All right, everyone. Welcome to the FEI Long Island webinar, Opportunities and Pitfalls to Consider When Filing 2021 Tax Returns. We'd like to thank our sponsors today, Platinum sponsor Robert Half, Gold sponsors MetLife, Nixon Peabody, BDO, and of course, Citrin Cooperman, who is running the program today. Citrin Cooperman is a full-service assurance, tax, and business advisory firm with offices throughout the country. The firm's approach ensures its professionals' primary focus stay where it counts, on building long-term client relationships. Rooted in core values right from the start in 1979, the firm's mission is to provide a comprehensive business approach to traditional services and proactive business throughout the life cycle of its clients. When you are free to focus on what counts, business thrives. A reminder to please complete polling questions and post-event survey so you can get CPE credit today. I'd also like to remind everyone that you can move the window or change the view by clicking any of the tabs on the top above where you see the speakers. So, because for the presentation purposes. Now I'm going to introduce our speaker for this webinar, Erick Torres, a partner in Citrin Cooperman's Long Island office, has over 15 years of experience providing tax planning and consulting services. As the leader of the tax practice for Long Island, he advises clients in several industries, including apparel, food services, technology, and manufacturing and distribution. Erick is a member of the Fathers United Now group for Jericho Elementary School and is a volunteer at Big Brother, Big Sister of Long Island. And without further ado, Erick, the floor is yours.
I appreciate it, Chris. Thank you. Good morning to everybody. I just found out that this webinar is a style where I don't get to necessarily interact with everyone from a visual perspective. I don't get to see you on camera, won't have any audio, so our main line of communication will be the chat down below. So as the presentation goes, by all means, you can use that chat function. To actually kick it off, I want to have a little nice, easy icebreaker. It's today's January 20th. It's one of our co-workers' birthdays today. She's on the line. Not as famous as others, so we'd go with the icebreaker. The icebreaker is going to be a question. First person to give me an answer that is correct will win a $50 Amazon gift card. We'll send it over to you once we get your email address. We'll send it on over. So I guess we'll just ask the question. So we'll start off. So the icebreaker is, my coworker's birthday is today, January 20th. Can you give me a famous person who was born on January 20th? First person in the chat to give me a person born today on this day wins the gift card. And I know some of you are going to cheat and Google. It's all right. If you don't know how to use the chat function is down at the bottom. We can post them there. George Burns. It's even on my list. Let's see. There was one, but George Burns in first. That is correct. George Burns is a person who was born. That is right, George Burns. Okay, congratulations. Wait, go on, that doesn't count. Go on as my coworker. Tom Cosman won the winner. I'm just trying to get used to this. So correct. Buzz Aldrin was born on January 20th. So he is the winner. Congratulations. At the you could just give us your email address. We will forward you on the gift card. All right. Thank you for the woohoo, Chris. All right. Awesome. Okay. So without further ado, we'll jump into the presentation. Go to the next slide for me, Chris. There's two main objectives and goals. The first is to understand the tax benefits of this pass-through entity tax regime that just came through. It's something that we've seen in practice. Our clients, other accounting firms are having difficulty grasping it. So it's going to be a little more technical than I normally am, but it's because I want to hit so many things as part of it that eventually will resonate with, hopefully with everyone that's listening in. It's an important benefit that's out there. We'll go through it, and obviously if you have questions, by all means use the chat to ask away. And the second is to awareness of some pitfalls as a result of the CARES Act, plus there's tax forms that are new, some that have been brought back, some tax laws have been brought back. So we've been in this spiral since 2017 of new tax laws that got suspended, other tax laws that sunset, some that got brought on in the middle during the pandemic. And kind of, it's hard to keep your eye on the ball in regard to what's going on there. And the tax practitioners are having difficulty keeping that together. So we thought, again, kind of arm you with some of these things that are happening so they could resonate in your mind. Think about if it applies to you. And this way, when you have a discussion with your accountant, you can have that as part of your discussion. I don't have it here as an objective and a goal, but this was meant to be more interactive. But since that's not to set up for a webinar, with the chat, if there's a tax topic that you'd like me to kind of go over, or a specific tax with general facts conversation that I'll try to maybe tackle. Before each polling question, I'll go through it. I'll go through the chat, see if anything pops up. This way I can kind of add to the flavor of this conversation so that it make it a little more personal to you. Obviously, it's not gonna be specific, but I can kind of confirm, deny, or kind of help you walk through something. You have something that's a tax question in running your business. This way we can kind of help you from there. All right, I think with that, we'll jump to our first polling question. All right, with the snow outside, are you feeling cold at the moment? Options are yes, a little, no, I love winter. Again, please complete the polling questions if you do want to get CPE. So it's important that you do complete them. Chris, I'm not sure how long you give them to respond to the polls.
We're almost there, about 30 seconds. Yep.
Okay. People are trying to gauge if they're cold or not at the moment. So you're feeling cold, okay. Yes, a little, no, I love winter. All right, good answer to those people that say I love winter, because we choose to live in this area, so we better love winter. We'll always have to deal with it. All right, excellent. Thank you for that. All right, next slide. All right, the pass-through entity tax. The pass-through entity tax was introduced by the state of Connecticut actually in 2018. It was put in to combat the $10,000 state and local income tax limitation. It was part of the Tax Cut and Jobs Act back in 2017 that limited that set up that limitation. And as being Long Islanders, we know what real estate taxes are out here. So combine real estate taxes with your state and local tax from New York, and if New York City applies to you, you'll know you'll be easily over that $10,000 figure. So what Connecticut did for its residents, it created what's called the pass-through entity tax, where in essence, the entity will pay the tax instead of the partner shareholders of that pass-through entity. Therefore, it said by entity paying the tax, you don't pay the tax, you get it as a credit, but you no longer have to consider that as part of your itemized deductions when you do a Schedule A. So it was a really creative workaround that they came up with. Again, it was back in 2018, especially at a time where this limitation was definitely affecting some of those big states that had either significant income tax regimes or significant real estate taxes. New York, Connecticut, California, you had those big hits, New Jersey. So it was real creative on their part to come up with that. When Connecticut came through with it, their election was mandatory. So it said, if you're a pass-through entity, you have to follow this regime now. There is no ifs, ands, or buts. You have to be part of it. They also said they considered that. So when the tax was paid, and I'll get to this a little while, it's important, the shareholders partners didn't have to worry about their quarterly estimates, including the income from these pass-through entities. They could carve that out. And if they still had estimates to make, then they still made the estimates, but they didn't have to consider that twice. That becomes an important fact a little later on, and I'll go over it. Now, an important fact that we saw coming through when we started looking at clients doing their tax filings, because the entity paid the tax, not the individual, we had a situation where, being in New York, I am mostly having a group of New York clients. They were looking to take the credit that they received. Again, the individual doesn't pay a tax, the entity. And they were looking to take that as a credit as part of their non-resident, part of their resident tax credit. So if you're familiar with that, if you're not, it's where, as a New York resident, if I pay tax in another state, I potentially will get that tax as a credit against my New York state tax. Therefore, I pay a little more in that state, but I also pay a little less in New York. The problem with that is because the tax is paid at the entity level, not at the individual level. New Yorkers specifically, because they didn't have this type of regime, said, you're not allowed to get credit for that. You're already getting a credit from the state of Connecticut for that. You cannot get a credit against the New York state tax. So it did have that effect on New Yorkers. So we kind of had to consider that and make sure that it's being reported for, because New York state was fairly quick to catch on to that. We started seeing when new clients came on board and we started seeing their filings, they're also getting notices from New York state saying, you took a Connecticut credit, they have this regime, we don't follow, no thank you. Next slide, Chris. All right, so here comes the summer of 2020. Only Connecticut had jumped into this regime. They had come up with it. Biggest reason was, in the tax world, you always have to be concerned at why you're doing something. If you're doing something to avoid tax, it generally isn't a good tax deduction. So why did Connecticut come up with this? To avoid tax, right? To help you avoid the state and local limitation. So it was very surprising when the IRS came out in summer of 2020 and said, we're going to come out with proposed regulations to give our opinion on this, that we agree that this is a valid state and local deduction at the entity level, and therefore it's a good deduction. A lot of ears perked up with that. That's when we got into that situation that a lot of states started to come into legislation and try to do their own thing. New York State being one of them. New York State joined the Cool Kids Club. New York State, New Jersey, Rhode Island, a slew of other states jumped into this game and said, you know what? If this is now a good deduction, then we really need to look into the legislation of this. New Jersey jumped on it pretty quickly. Here came New York. Next slide, please. The state of New York, in their infinite wisdom, came up with their own regime. It was the summer of 2021. They came out with their guidelines. Okay, very first guideline is that the regime can start being applied to calendar year 2021 tax filings. So if you consider calendar 2021 tax year, what's the problem in that? Fiscal year filers, fiscal year partnerships, S corps. When does that apply to you? For New York State purposes, they eventually came out and said, your 2021 tax year, it will be based on when your year ends. So at this point, our fiscal year filers on our S corps were pushed over a year. Okay. They also then came and said the election must be done by March 15th of the tax year for it to apply. So they're coming out in the summer of 2021 that something applies March 15th of the year. We're a few months late already. They came out with additional guidance and said, okay, you have until October 15th, so this past October 15th, 2021, to make that election for 2021. There was a mad dash to make those elections, which leads us to our next issue. how do you make the election? Most of these states have been coming out with tax forms, schedule statements. New York State decided to use their online services account. So as we know, as tax practitioners, we don't really log into online service account for our clients. You being the business entrepreneurs and the business owners and the accounting professionals, you're part of that. So you go into the online service account, and in their technical memo, they actually said the tax practitioners are not supposed to make this election. So that's where the problem became a burden to the taxpayers, because now the taxpayers were supposed to log into their online services account, go through the steps, make that election. What we ended up doing at Citrin Cooperman is we actually, to help that, we created a walkthrough using pictures, using color art, and just kind of made it simple to say, if you're a partnership, these are the steps to follow to make the election. If you're an S Corp, these are the steps that you make. It ran pretty smoothly for the most part. There were some hiccups because of the short time frame that New York State gave us. Their website started to crash several times. So it made it interesting that they'd rush all of this and then not really give people the opportunity to do it. The fourth highlight, and I had brought this up earlier, participating partnerships and shareholders are still required to make their quarterly estimates. So where Connecticut said, look, if you pass the entity, is forced to pay the tax and pay the tax, you don't consider that income when you're doing your estimates. New York State and a handful of other states, New York, New Jersey, California, have not done that. New Jersey does have something into their current law that may give similar treatment to Connecticut, but New York State right now is talking about when you make your estimates for personal, you have to include that income in calculating your estimates, pay those estimates without the fact that you're considering you're going to get a credit for the taxes that the entity level paid. So what does that mean? That means that you'll still get the deduction at the entity level, okay? And you have to make a payment at the entity level. But then again, on your personal income tax estimates, you'll have to make a payment there as well. So it's significant cash flow. You're almost looking at double your cash flow to make, to take a benefit for this election, to get the benefits deduction. So it's a cash flow hit. We've been talking to our clients. We give them a technical and a practical answer. We've been telling them player options. The technical response is that you are required to make your estimates, including that income, not to consider the credit. Practical, we've been seeing our clients kind of going without it. Go, I don't want to give New York State, anybody else for that matter, any more of my money. So we're going to go ahead and just not include that piece. If I still owe estimates, not including my income from my pass-through entities, then I'll make that estimate, but I'm not going to include it in my estimate. It's a significant cash flow. We've seen it. Also, the calculation of the tax is actually pretty high because it's based on the total income of the pass-through entity. So in a situation where the company makes $2 million and you're only a 5% shareholder, you think you're going to get 5% of 2 million. However, the calculation for the credit is based on the 2 million. So you could be at the highest rate, even though you're probably at the lowest rate generally. And that difference will just be made up on your personal return. So again, you're getting that hit from a cash flow perspective. You're getting that nice deduction. Something that I kind of made it clear to the practitioner community that I think it actually made it even better. For those that remember before the SALT limitation, in the middle class in Long Island, you're paying your real estate taxes, you're paying your state and local taxes. You had to worry about something called the AMT, the alternative minimum tax. And in that regime, it didn't allow you to take the deduction for your state and local taxes. Although you thought you were getting a deduction for it, you weren't. Now under this new system, it literally circumvents that AMT. So you actually are in a position where you're better off. So again, this is why this regime does have its tax benefits to it. You're getting a significant deduction, not worrying about AMT, not worrying about the state and local limitation, and you're still able to now get a benefit for all your state and local taxes paid. So that's why it's something that, although from a cash flow perspective, you have that hit, it's still advantageous to go through this. So that's why I think it's important that everyone get a full understanding of what it is. I still have clients I speak to today and they go, remind me what this thing is. And that's what this is. So it's significant. It's an important aspect that you consider that when you're doing your business books, when you're talking to your own clients, when you're looking at your own situation. I'll get into some other investment other alternatives to consider to take a benefit for this. But it's important to have the conversation for this. And the last point is, which is a common from a state and local perspective, whenever there's a tax paid for a state and local, it's an add back for calculating the tax again. If not, it'll be this reciprocal function. So just to throw it in there. The next slide, if you go to the next slide, Chris, just kind of want to walk through, because again, in their infinite wisdom in New York, they decided to calculate the tax differently from S corps and partnerships. So from an S corp perspective, and you will aggregate all your income, all your gains, your losses, your deductions, even like charity. So we know there's limitations on your charity, there's limitations on your 179 deduction, but you put it all together, you pool it together, and then you apportion it to the state of New York. So in our businesses here that are mostly in New York, the apportionment will be high. That'll give us the opportunity to have a higher base, which means we pay more tax now, but again, you're going to get it as a credit. So you almost want to build up that number because you want to do that. So in operations that are mainly in New York, that's a great benefit for those operations that are multinational or across the country. You're going to have a diluted apportionment factor, so that number isn't as high, but it's still a benefit because ultimately, if you're paying New York State tax, you want it to be paid through the entity generally versus paying it on your own and subject to limitation. So that's in it there. It's an interesting stick there because of whether you're a New York resident or not. In this calculation, you have to apportion it. Let's jump to the next slide when we look at partnerships. Partnerships are interesting in the fact that if you are a resident, a New York State resident, you don't apportion it. So if the company makes $100 and you're a 20% owner, $20 is your portion that you're going to include in the calculation. As an S corp, if you were making $100, you're a 20% owner, and your portion is only 50%, you're only considering $10. So in an S corp, you're considering $10. We're in a partnership, you're considering $20. So that's a big difference in itself right there. Non-residents are more similar to how S corps are, where they have to apportion it. So they would be in the same boat, S corp partnership. It's important to be able to delineate the difference because it's a planning opportunity if a company's looking to be acquired or a company's looking to restructure, what you're looking at. So whether you're a partnership or an S corp, it makes a difference. I put in here, talk about Article 22. Article 22, it just means for you to be a participant in this, you have to be an Article 22 taxpayer. So those are individuals, trusts that pay at the entity level. It's important to consider trusts. If you have a trust that is an owner, if I don't use too many types, if you're a grantor trust, you should be fine. But if you're a tax-paying trust, be careful with that because New York State specifically said you could be part of the regime to do this. However, the credit that you generate from that, you can't push down to the beneficiaries where the income is. So you could be in a situation where you're not passing through the income to the beneficiaries, but not the credit. So you would have unintended consequences there. So it's important that you go through those pieces. In a situation that you have a partner that is a partnership, that is a corporation, those are not Article 22 taxpayers. So they will get their share of the income, but then it'd be carved out for calculating the tax. If you have an entity that's only owned by partnerships, so an LLC that's owned only by partnerships because they have tiered levels, then there is nothing to file because they will determine if they have to do a filing. All right, so that's New York. California works differently. New Jersey works differently. Rhode Island works differently. So it's become a much bigger deal, and unfortunately 50 states, 50 different laws. So that's the S corp and partnership side of it. Said a lot Does anybody have any questions? Anything they want me to clarify? You can use the chat, obviously, to put any comments in there. It's a lot to bring out. Can I ask from those participating, who's aware of this pass-through entity tax? Like, who's had conversations with their accountants, with the business accountants, have made the elections? I'd like to see, just get a grasp, because I see a 50-50 split. Hopefully I have a group here 50-50 split, so I'm at least educating somebody in the room. I'm just trying to see how to open up the chat again. Maybe people don't know, which is perfectly fine. We've been trying to go through that. Not heard of it. Okay, so hopefully. And Patricia, are you involved in the accounting aspect of the business? Are you involved in the in your own personal level? Are you an owner? Where are you in this? Are you in finance? So would you get? You could be in a situation that it may not affect you, but I'll talk about it a little later how it may have indirectly affected you, you don't realize it. Okay. Well, I guess while I wait for people to respond, Chris, why don't we jump on to the next polling question? All right, so polling question number 2. How difficult are your taxes? Are they easy, fair, complicated, or I just let them take my money? Single choice in this one. So Patricia, with that partnership, it's definitely a consideration you should be considering with your accountant if you do your tax filings. Looking to make the election. It's obviously too late for 2021, but 2022, you still have roughly 2 months to make the election for 2022. All right, and here are the results. Fair, I like that. No one just said let them take my money. That's important. That means you care about what you're doing. I agree. Don't let them take your money. It gives us, the accountants, a job, right? More people respond to that. Question 4, less opportunity for accountants to do what they do. Easy and fair. Easy is a term that's going away every day. As just consider it from a standpoint as you have different regimes in a political world when they're flipping back and forth, blue, red, blue, red. Tax laws are constantly changing, blue, red, blue, red. So you could be in a situation that before you were not considered, you're a straight W-2, and then all of a sudden something comes in and now it affects you. And now you have to consider something different. And there's a carry forward effect to that. Unfortunately, the term easy is one that is rarely seen nowadays. If you consider yours easy, very good, congratulations. Okay. Any questions? Anybody else have any thoughts? Or I just jump on? No? Okay. So let's jump to the next slide, Chris. This is where I talked about planning considerations. This is some key stuff that we've talked to our clients about. Like it was mentioned earlier, I run the tax practice for Long Island, so when I'm sitting with my tax partners, we'll have conversations with the clients. I like to just sit with them, see what's going on. These are the things we've been talking about as opportunities. Some that I brought up, some that they have brought up. We pull these thoughts together to come to our clients and bring them ideas. So the first one, partnerships having no New York activity, but they have New York partners. This becomes one where people don't realize that. I have a client that goes, hey, I have a real estate property in Georgia. What does I have to do with it? Well, because you're a New York resident, that Georgia filing actually requires to do a New York state filing as well. So therefore, on your New York state filing, if you go back to the prior example, being a partnership where it makes $100 and you're 20% owner, you can take that 20% being a New York resident and actually do withholding on that. That benefits you because now you're paying tax. You're going to pay tax in New York anyway. As a New York resident, you pay tax on all your income. You'll get the opportunity to now take that as a deduction at the entity level and give you the opportunity to take that deduction where if you just paid Georgia taxes, your Georgia taxes would be subject to your state and local limitation, and it goes away. So that's one that we started to have a lot of communications with our clients about, because we don't do every single pass-through business interest for our clients. So we started talking to them. You got 10K1s, we did 2 of them. Have you spoken to those other 8 businesses? Have they considered your activity? Have they made the election for you? Are you aware how much tax they paid on your behalf when it comes to you making your estimates? Because it could reduce the amount of estimate that you have to pay during the tax year. Did they miss the election? And because this was so rushed, it's common to have missed the election. We get it. It's just too much was going on in those last 3 months of 2021. So have those conversations with the people you're getting K1s from, your advisors, whoever runs your hedge fund. Or have you made these New York State elections? Just because they're not in New York or they're throughout the country doesn't mean you can't benefit from it. So it's important that that's a conversation point that you have with them. A second situation that we've had is the expectation to start doing business in New York. So it just happened. I was talking to one of my clients, a California based. He said, come the summer, they'll be operating in New York. That election to apply for 2022 has to be made by March 15th. So now I have my client being proactive, setting up their online services account, making the election. So should they turn profitable in New York, that can start benefiting them from that perspective. They can start making that election and they can start paying tax on that. Yeah. Another situation, mergers and acquisitions transaction. It's really heavy right now. A lot of M&A transactions. We're involved on due diligence on both sides of it. We've had specific discussions with New York on this, with their legislative body, and they have said that if one entity acquires another entity and that first entity made the election, that election will not flow through to the new election, to the new company. So it's important that that new company look to make the elections to continue participating in this situation. So it's not one thing that it doesn't always happen to this group. I don't know if it's that big in this area, but I think it's important to at least bring it up from that perspective. If you are part of a business or if you work with someone who is going through these transactions, that they make that as part of their consideration for their reporting perspectives. Okay. A fourth item, investment partnership. So you may have heard of family limited partnerships, investment partnerships, where it's a pooling of monies to make investments. There was a lot of back and forth in regard to, all right, if I make this election and I pay this New York State tax, how does it look to me as a partnership? I'm an investment partnership. Investment expenses are generally have limitations in regard to how much you can deduct on your Schedule A. I think it's before 0 at the moment. So you lose your investment expenses. You're saying, wait, so I'm going to pay this tax and still not get a benefit for it. Is it worth it? We've had some caucuses with other significant accounting firms. We came to a conclusion that this should be an ordinary trade or business expense. So on a 1065, say, it would be on page 1 versus all your other investment activity that flows, that is part of Schedule D, Schedule A, not Schedule D, but Schedule B. So you'll have, it's not going to be an investment expense. It's an ordinary expense. So you'll have a negative number on ordinary income. So that's important. That's significantly important because you'll be able to still pay tax under this regime, New York State taxes, and still get the deduction for it. It's an ordinary loss and still take a deduction for it. So that is what we're sitting. That's the position that we're taking. Again, the IRS has not come out. It's supposed to be part of the proposed regulations. But in conversations we've had with down at the IRS, that seems to be the way that they're going to be treating this as. So important to consider that as well for those that, again, who maybe have family partnerships, pooled money together with friends, family, are investing. You can still elect into this and it's still a good deduction for these investment partnerships. The next one is a significant item, our Schedule C friends. I'm not quite sure how many people on the panel here have Schedule Cs. People tend to use Schedule Cs because they're simpler for filing. You don't have a separate filing. You don't have a separate S Corp, C Corp, partnership filing, whatever the case may be. It's part of your 1040. Because it's part of your 1040, it's not part of the pass-through entity tax regime. So we've actually had several of our clients recreate their business, put themselves in a pass-through perspective. I have clients making a couple $1 million and it's all on their Schedule C. They're paying a significant tax and there's no benefit to them. Sometimes they may be going through a transaction or there's another reason why not to, but it's worth having the discussion. So anyone here who has a Schedule C, who has even a smaller perspective, you can structure yourself to be an S corp, structure yourself potentially to be a partnership. With a partnership, you need to have at least 2 partners, but you can put yourself in the right way to then have that situation where you're now a pass-through entity. Yes, you have one more tax filing, so add another $2,000-3,000 to that expense, but then turn around and say, okay, if I'm going to pay New York State $30,000-40,000 in taxes, I now get a 30% deduction on those. Is my tax rate around 30? It exceeds the cost of my entity filing. So it's one of those things that right at this point is here to stay. Based on the most recent bill that was put to Congress, they were not looking to modify the state and local limitation. So at this point, this workaround is working out. So for all our Schedule C friends out there, you should definitely have a conversation with your accountants, talk about setting up a different legal structure so you could take advantage of this. Okay. And I had mentioned it earlier before, keep in mind that there are 16 states that currently have some type of pass-through entity regime or have one in their legislative cycle. So it's important that if you're doing business throughout the country, you're looking at this. New York was very painful in regard to by March 15th. A lot of these other states that have already established their pass-through entity regimes are giving people to either the original filing date or they go on extension, the extended due date. But each state has their own deal. So hopefully your accountants have the state and local team behind to give you the options that are available so you can determine where you want to make elections and not. All right, Connecticut is one that's mandatory. I believe it's the only one that is mandatory at the moment. So all the other ones seem to be annual elections. New York is an annual election. It's irrevocable once done, but it's an annual election. So if it worked out for you in 2022, you can keep going potentially in 2023. If it didn't work out for you in 2022, you don't have to make the election for 2023. Okay. Any questions, any thoughts? Anyone on the other side have any considerations, anything they want to ask that may pertain to what they do for a living? Okay. Let's jump to the next slide, Chris. So this we set up just as a comparative, give you the opportunity to just see the difference between New York and Connecticut. Again, Connecticut is one filing. New York State has 2 filings. So the entity will file a S corp CT3 or a partnership, which is the IT 204. It's going to have its own separate filing for the PTE, similar to the election. New York State literally just came out 2 days ago with a correspondence with us specifically and said most likely the return will be on the website for the taxpayer. That means that taxpayer will have to do some due diligence to file the filing, make any payments, stay on top of estimates. So we here at Citrin Cooperman are working with workarounds, working with models that you can follow to put that information into the system so that you can take advantage of this credit. It's interesting that they've gone this direction, but it is what it is. Okay. The election, again, the election is an annual election for New York. It's mandatory for Connecticut. Connecticut started in 2018. New York State started in 2021. One thing I did want to bring up with that, if you remember when we was talking about Connecticut for 18, 19, and 20, New York State did not have this pass-through entity regime. Therefore, any of those credits that were received in Connecticut, you couldn't take it as a resident credit when you filed your New York resident return. Because in 2021, New York State now has that pass-through entity regime, they have come out and said, now we will respect that credit. So now in your 2021 return, If you're a New York resident and you file in Connecticut because you have an investment in Connecticut, operations in Connecticut, as an individual, you'll be able to now take a credit for those taxes paid in Connecticut. So back to the old system of pay a little more in one state, but I pay a little less in my state. So that's kind of evened that out, which was a significant difference there because you were paying tax in two different states, but New York at least has clarified that. And again, the fourth piece about the withholding, Connecticut doesn't require withholding, but New York, like New Jersey, requires withholding on both ends. New Jersey's a tough one. New Jersey forces you to make the withholding on both ends. There is something in the legislative branch right now that I think is actually already on Governor Murphy's desk to not have that push, to not have your personal estimate required to include that income as well. So if he signs it, that'll be there. New York State at this moment requires it. Again, require versus doing it practical versus technical. Technically required to, practically it's up to you what you consider. I think the underpayment of estimate penalty is worth peanuts compared to keeping the money in your bank account, then you have that opportunity. Okay. Any questions? Anyone have any thoughts? Any other tax topics they want to bring up before we pick up polling question number 3? Nothing to worry about. Okay, very good. All right, with that, Chris, let's jump to polling question number 3, please. All right. I'll read along for you guys. What is your favorite vacation spot? The beach, hiking trails, no getaways, or your accountant's office? If you come to my office, there is alcohol, there is sports memorabilia, there's a punching bag. So there are relatively different activities and exercises if you did come into my office. The beach, 85%. I'm wondering if I asked this question at some point in the summer, would it be the other way? The hiking trails, snow getaways, we have no one who likes skiing, I guess, to go out there. The beach is a very good option. I was thinking of throwing Disney World into there for those that are Disney fanatics. My wife and kids are, so that is their go-to. I thought that would have been too easy, but the beach is also another good option. So, all right, thank you for responding. Okay. Next, our pitfalls for 2021. Our pitfalls for 2021, again, I wanted to kind of go over items that were introduced in earlier tax years that maybe went away due to coronavirus aid, that either suspended items or just got rid of them completely and now are back in the picture, or there are opportunities for cash savings, but now they're bouncing back because there are only deferments. So the first one is the coronavirus related distributions. So in 2020, you were entitled to take distributions out of your 401k as long as the employer participated up to $100,000. And by taking out the $100,000, you weren't subject to the 10% penalty, nor were you subject to withholding at the time of distribution. The carve out to that is that you have 2 options. One, you can amend your 2020 filing and pick it up into income if you ended up being in a loss year and you said, you know what, might as well pick up the income in 2020, so I'm in a loss year. It won't affect me from a tax perspective. This way, let me just pay all the tax now, but you won't actually pay tax. Or the second option is to ratably spread it over 3 years. So if you took out $30,000, you'd pick up $10,000 in 2021, $10,000 in 2022, and $10,000 in 2023. That's all reported on the form 8915E. You'll see it broken out there. So it's important that you consider, if you did make any coronavirus related distributions in 2020, that you may have an income pickup in 2021. Actually, another strategy that we did consider was I had a client who his income was going to be significantly higher in 2021 than in 2020. So we did amend, include that income in 2020 because we got a benefit just for the tax rates in itself right there. So again, if you did have a corona related distribution, take a look. Next slide, please. Okay, so this limitation on business losses, accountants like to use codes 461L, I believe. This one was introduced in 2017 and then quickly shut down by the coronavirus aid. Oddly enough, New York State didn't conform to that. So if you're a New York State resident, you were subject to 461L, you were still getting that limitation on your 20 tax filings. You're in a situation where if your losses for the year, so starting in 2021, if your losses for the year, so your regular trade or business losses are greater than 425,000 married filing jointly, you will have a situation where your losses in excess of that are limited. Where that becomes a situation is I've had clients that have significant portfolio income, but significant trade or business losses. So from 18, 19, and 20, they were in the opportunity is to turn around and say, all right, I'm going to take those losses to offset my portfolio income. Now in 2021, with that limitation, you're now in a situation, even if you're single, I have a client who's single going through the same thing with 262 limitation, that now they're going to be paying tax on their portfolio income. Those losses do get suspended and get to carry forward. So you can always consider them year to year, so you do not lose it. However, it's a significant planning situation to consider for your 2021 tax filing in regard to what you're going to be paying, because you're not going to have that opportunity to go that route. Next slide, Chris. The interest expense limitation. So this is 163J. For those who have or part of businesses that have average gross receipts greater than 25 million, you are subject to this. There's a second caveat that it's important because it's burned people in the past. That top right, syndicates may not avail themselves of. A syndicate is simply a tax an entity that has greater than 35% of its losses being allocated to passive individuals. So in a situation where an easy example is having a real estate investment in Massachusetts, the person who's operating anything only owns 5% and the other 95% are passive investors. That entity is subject to this limitation right away. It doesn't have to hit that 25 million average gross receipts. So it's important because all of a sudden, like in the real estate world where mortgage is a significant aspect and interest is a significant expense, you could be putting yourself in a situation that if the rental activity is not high enough, you could be limiting that interest expense deduction. In 2021, you're entitled to, in your calculation of your limitation, bump up your income by depreciation and amortization. Therefore, the higher that is, the less of your interest expense would be limited. However, starting in 2022, that depreciation and amortization goes away. So in a situation where your taxable income is $100 and part of that is $20 of depreciation amortization, your base for 2021 is 120. So 30% of that is 40. So if your interest is at 37, you're fine. However, if 2022, your income is $100 and your depreciation amortization is 20, it's not going to be added back. Your base is still 100 and at a haircut and at 30% of 100 is 30. If your interest is $37, you just got $7 suspended. So it's important to take those things into consideration because that's what's that may put you in a position where you need to start making distributions to your partners, to your shareholders, because they may have income being flown to them now, and you now need to consider the cash flow ramifications of that. So that's something that's coming up in 2022, estimates to consider for 2022. You do have to have that calculation as part of your operations. Definitely for sure, if your business is debt intensive, like real estate, like equipment resellers that take out loans to buy equipment to resell at a higher value. Those things you have to consider those aspects of it. Okay. Next slide, please, Chris. Okay, so new tax forms for 2021. Some of them are new, some are actually used. So the 461 we talked about before, with the business loss limitation. That's provided on Form 461, so that will be coming back. The New York State pass-through entity tax filings. Again, New York has come out and said that they're going to be most likely reporting that through the website. So from a perspective of the taxpayer may have to do some work, hopefully your accountant is able to give you some type of walkthrough, some type of breakout to how to actually report this all on the website. I'll be honest with you, it is worth, the tax deduction is worth administrative complexities. So it's a significant benefit there. So it has to be considered. Schedule K and Schedule K2 and K3. We're all familiar with Schedule K1. It's attached to partnerships, attached to S corps, attached to trusts that are not grantor trusts and tax-paying trusts. You may have some type of K1 filing. The IRS has come out with Form K2, K3, specifically designed to account for when you have foreign partners and or foreign transactions. So be aware that if you have one of those two, obviously you're not going to have foreign partners for an S corporation, but for a partnership. If you have foreign partners in an S corp, if you have foreign transactions, you will have to do additional reporting under Schedule K2 and Schedule K3. This becomes important because it obviously adds to the complexity of tax compliance, the additional reporting that the IRS is requesting. A lot of this was meant to capture what gets put in white paper detail of K1s and actually put it on line items to ease the compliance process in the future. Obviously not year one, but into the future and what gets reported there. So keep that in mind if you do have foreign partners and or foreign transactions, that most likely your return will require a K2 or K3. We just got notified from our software vendor, which is the largest software vendor, that the IRS has told them that any return that has a K2, K3, partnerships at earliest they'll start processing is middle of March. S corporations, early June. So that's the processing aspect of it. So just please keep that in mind when you're dealing with your accountant and in regards to processing, getting K1s in there. That becomes a burden when all of a sudden you need the forms to be filed and the IRS just hasn't gotten to them yet. And whatever you may need for your mortgage, or you need the activity to pass through to your personal returns, keep that in mind that if you have that activity, you may have that as well. All right. 21 tax advance child tax credit payments. If you have dependent, you have children dependents that you claim a child tax credit for, there were payments made throughout 2021 to kind of give some of that payment back in advance to stimulate the economy. So if you are getting direct deposit of your refunds or direct payment of any payments you have with your filings, they had your bank information on account, they were using the same bank account to start giving you some of this advanced tax credit. That you should have gotten a form already. It's a schedule that is going to be reported part of the Form 8812, which is where you report the child tax credit forms. So please make sure that if you had that last year, that you may have already received some of that portion of that credit and received this letter of information. Your accountants will need that so that they can reconcile what the actual credit is at the end of the day. Obviously, it's from a double dipping perspective. Last thing you want to do is miss out on it. And then all of a sudden you get a letter in the mail because you didn't provide that to your accountant. You said you didn't, the one wasn't issued. And then all of a sudden the IRS comes knocking for more money. So just keep that in mind. Two other things I didn't include in this, R&D studies. If you are getting an R&D study, be aware that for anyone who's amending to file an R&D study, that the documentation requirement has significantly increased. So just keep that in mind that when you are amending, right now it's specifically amending returns to claim R&D studies, that they are expecting the R&D providers to provide studies that give further documentation into the different services that trigger the R&D savings. So just keep that in mind when you're talking to who you're using. That's what we're doing from R&D. We don't do at Citrin Cooperman, do not prepare R&D tax studies. However, we do have vendors that we use. We've vetted the technology aspect, vetted the deliverable, and the audit success are important to us. So this is part of the conversations we've already had. We wanted to confirm that they're doing their due diligence to make sure they're ready to go for our clients' sakes. And the last thing I don't have in there is the employee retention tax credit, the employee retention tax credit, the ERTC, that was really popular at the end of 2020 and 2021. Be aware that if you did amend your 2020 tax file in Q4 941 to take the credit for Q4, the guidance that came out from the IRS a couple weeks ago, no, actually it was, actually said that you have to now amend your tax return that reported those wages to account for that reduction. That is specifically in the guidance currently what has to get done. So keep that in mind. It's not a situation where you'll be able to reduce your expense in 2021. You would have to amend your 2020 to reduce that expense. S Corps, it's a straightforward process of amending. If you're a partnership, there are new rules for amending partnership tax returns. So be very vigilant of that when it comes to amending, because although the credit was fantastic to businesses in Long Island because it gave us the opportunity to continue to keep our employees working, it added that benefit. However, it did give us more administrative headaches to handle. So please make sure you're staying on top of that. All right, so that's, before I jump to the next polling question, let me just see if I have any questions. Can you convert a 401k loan in 19 to a coronavirus distribution in 2021? The coronavirus distribution was a 2020 item. You'd have to speak to your employer to see if they gave you the opportunity to make that distribution. I don't think they have. I've not seen one that has. So it obviously start off, if your plan allows it, and it doesn't allow it, then you wouldn't be able to. Second question, is there any conversion of permitting use of 529 fund withdrawals for non-education expenses or other retirement uses? They did expand the opportunity to use 529 plans. It used to be for higher education only. So anything above high school level education, you're entitled to use the 529 credit for. They expanded that to include below high school level and also even private school. So they expanded it from that perspective. I'm not aware of them allowing you to use that for retirement uses though. So hopefully that answers those questions. All right, Chris, can we get to polling question number 4? And thank you for those questions. Did I put Chris to sleep? Maybe taxes can be exciting for some and not for others. I don't know if I can take over the screen. Chris, if you could do pop up polling question number 4. It's not as fun as the other ones. Maybe that's why he doesn't want to do it.
A Zoom error. Yeah, but let me try it one more time. Oh, there we go. Can everyone see it?
I see it on my end, so we're gonna take the assumption that they can on their end.
Yep.
Thank you for that.
Yeah, they're starting to come in.
Okay, perfect. So what's the best way to contact Citrin Cooperman? You can go to our website. You can email me directly. Social media, LinkedIn. There are other platforms that once you use a person's LinkedIn, you can see what other platforms are related specifically to Citrin Cooperman. Or you can give us a call at our Long Island office. I am based out of Melville. However, I do work with clients throughout the country, throughout the globe. So just being on Melville does not limit the access exposure that we have. As mentioned, we're a full services firm, so each office has experts specifically in different industries, different tax practices, state and local, international, trust in the state. That's been a big component to there. So I actually like the answer because if you visit citrincooperman.com, you can actually register yourself for, I wrote them down here just make sure I get them all. You can set them up for, if you register, you can get tax alerts specific to the industry that you're involved in. So anything that may be a think tank that's coming through, opportunity that's coming through, legislation that's coming through specific to your industry, you'll get email alerts from them. We don't spam as much as you may think. We don't share the information from that perspective, I don't think. But it's usually that. You'll get general alerts If there's a federal update, that's obviously going to affect broad coverage, we'll send that out to the group. Tax alerts, anything specific to state and local changes. In regard to this New York State PTE, we're putting together an alert. We're actually going to be putting together presentations that I'll be training the entire firm in regard to actually how to handle this tax. And then we'll eventually have something in the simpler format that we can give off to our clients who are looking to get access to that. And it also gives you notifications on upcoming Citrin podcasts, live in-person presentations, webinars, and the likes. So a lot of good stuff there. I am talking a lot of tax, but the beauty of Citrin is we're a very entrepreneurial type firm. We do a lot of podcasts that are not tax related, that are not accounting related, audit related. We'll do conversation podcasts with one of our clients that's in manufacturing, someone that's in the automotive world, someone that's in the PE world, and just be able to have a strong conversation about their industry, what they do specifically, that just helps kind of see what's going on in the current atmosphere. So it's a lot of good information there. By all means, please, we'd appreciate if you register and log on. We'd love to share what we've learned from you. Okay. All right. I think that's it for my end. A couple minutes over. Let's see. I think we have one more question coming in. You mentioned, what about certificate courses or prep education for CPAs and IMA exams? No, it's supposed to be, so that is actually generally not a deduction that you can take to begin with. It's a little caveat. Expenses paid to earn a license are technically not deductible items. So they generally are not allowable to be used out of a 529 plan. If you're in a situation where you have set up a 529 plan to a specific beneficiary, and that beneficiary didn't go to school, received a full scholarship, doesn't need any expense like that, you can transfer that to another beneficiary so they can use it from that perspective. Okay. So thank you for your question, Manuel. All right. I think that's it. All right. So without further ado, thank you again for your time. Chris, thank you for moderating. Appreciate it. It's nice.
Thanks very much, Eric.
Thank you for everyone's hour of attention. It is about lunchtime, so hopefully I did not make you lose your lunch. You can go enjoy yourself now.
All right. Thanks, everybody. Take care.
Thank you.